This is an Uncovered Japan Company research report on NexTone, ticker 7094. NexTone is Japan's only private sector music copyright collecting society, the sole listed challenger to JASRAC's long-standing dominance. The unusual franchise is now combined with digital distribution, Rekochoku streaming, and creator support services. We will examine the moat, the lower margin mix, the valuation, and the execution risks that make this a wide outcome investment story. The report is dated July 4th, 2026, using a reference share price of 1,409 yen from July 3rd. Forward earnings were valued at 13.8 times. Fiscal 2026 return on equity was 15.3%, and the dividend yield was 1.56%. The report scores growth and value at 4 out of 5, but supply and demand at only 1 because margin buying positions were exceptionally heavy. NexTone's core job is invisible but essential. It registers songs, licenses their use, collects royalties from platforms and venues, and distributes the proceeds to rights holders. Its digital distribution arm delivers master recordings to Spotify, Apple Music, YouTube, and other services. The Rekochoku acquisition added consumer streaming and downloads, while business support offers fan club, casting, and related services. Together, these activities form a full-stack music intellectual property agent. Revenue rose from about 7.5 billion yen in fiscal 2022 to 20.8 billion in fiscal 2026. The biggest jumps came from acquisitions, especially the consolidation of Rekochoku after NexTone bought 51.7% in September 2023. Operating profit did not rise in a straight line. The group absorbed a lower margin mix, fell into a fiscal 2024 trough, and then recovered to 1.3 billion yen. The segment picture explains both the attraction and the problem. Copyright management, the licensed collecting society franchise, earned a 43.9% segment margin, but represented only a small share of reported revenue because NexTone books its commission rather than gross royalties. Digital distribution supplied about half of sales at a 10.1% margin. Music streaming earns 20.3%, while business support remained loss-making. Scale increased, but average quality fell. The moat begins with regulation. Japan's 2001 Copyright Management Business Act allowed licensed private firms to compete. Yet NexTone is the only one to build meaningful scale against JASRAC. Through its predecessors, it also has a 2-decade head start in digital rights and established relationships with labels, publishers, artists, and platforms. Its estimated collection share grew from roughly 2% in 2016 to around 9 or 10% by fiscal 2026. The license is necessary, but the operating network makes the position durable. Cash flow provides a steadier picture than the consolidated margin. Operating cash flow stayed between roughly 1.1 and 2.2 billion yen in each displayed year, and fiscal 2025 free cash flow was about 1.6 billion. The balance sheet also contains large royalty-related receivables, payables, and cash that pass through to rights holders. Those items increase headline totals without representing conventional financial leverage. The report describes the underlying company as debt-free and reliably cash-generative. The equity ratio fell when Rekochoku was consolidated, then recovered to 35.2% in fiscal 2026. Return on equity remained in the mid-teens at 15.3%. This is not a balance sheet repair story. The more important question is whether NexTone can expand the high-margin copyright arm and improve the acquired businesses quickly enough to lift the consolidated margin without another large deal or another guidance reset. The revised midterm plan targets 24 billion yen of revenue and a group margin above 9% by fiscal 2028. That revenue target was cut from 29.6 billion within one revision, fitting a longer history of ambitious guidance. The upside options are real: overseas royalty collection, major catalogs, further share gains against JASRAC, and a targeted prime market listing. But each requires execution, and the report argues that company forecasts should be discounted until milestones appear in reported results. At 13.8 times forward earnings, NexTone traded near its historical low multiple and far below the broader growth market information technology average cited in the report. Yet it was only modestly cheap against selected entertainment peers, and its dividend yield remained below several music companies. The other discount is supply and demand. Margin buying positions were roughly 11% of shares outstanding, with a credit ratio near 31 times. Fundamental improvement may not immediately remove that overhang. These are the report author's scenarios, not price targets or investment advice. From the 1,409 yen reference price, the 3-year range runs from roughly 70% downside in the bear case to about 150% upside in the bull case. The width is the message. Small changes in execution, margins, and the valuation multiple produce very different outcomes. The cleanest indicators are copyright collection share, the group operating margin, guidance delivery, and concrete progress toward a prime listing. To conclude, NexTone owns a genuinely rare position, the only private sector challenger to Japan's music copyright incumbent, with a high-margin core and a long runway if it keeps taking share. The Rekuchoku deal added scale and strategic options, but also diluted margins and exposed investors to a mixed execution record. The valuation is low, yet the outcome range remains wide. For the full evidence, assumptions, and source detail, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.